Today. Christine, thank you so much for your leadership. It's a big job leading up these AFP chapters, and they are the lifeblood of our profession. I truly believe that I would not have gotten my CFRE without it. And uh, forget about letters after your name. It elevates my happiness factor. I love hanging out with fellow fundraisers who are doing this work together. I love this community. So as I told Christine before, I developed this presentation actually at the insistence of my own board at AFP Golden Gate because I was one of the first people to tap into the huge implications that OBA, the One Big Beautiful Bill Act, was going to have on the lives of our nonprofit fundraisers. And I didn't feel like anybody was really talking about it. This was back in July of last year. And now that the bill has been signed and now fully enacted as of January 1st, I'm very motivated to get in front of as many AFP and nonprofit fundraisers as possible so that we all have this information. So I'm just happy to see you all here. And as Christine said, we'll take any and all questions, and I will stay on this call as long as there is a question to be asked. I will also tell you that this is not a great presentation to be doing double duty with your email inbox. This is a very info-rich presentation, and it builds on itself. So if there's really something you're stuck on as we move through it, I think I've designed it with incredible focus on making things clear and digestible. But if you're stuck on something, Christine's going to help us out and interrupt me to make sure that we're clarifying the question. And anything else, additional questions, we're going to take at the end for as long as you would like. So feel free to add yourself to the chat. I'd love for you to introduce yourself and share one thing you love about where you live. I was thinking everybody was coming from Miami, but man, we have such a nice diversity of folks here today. So bring it on. And I'm happy that you're all here today. So today we're talking about navigating the 2025 tax law, the winning playbook for high-performing fundraising professionals, or how I like to call it, how to become a generosity guide. And at the moment, you don't know what that means yet, but I'm going to tell you. Um, and Christine is going to send you the recording of this presentation. But if you would like written training guide, which I highly recommend, please use your phone and scan this QR code. I also put the link in the chat and join our mailing list, and we will send you a very detailed training guide as well as a strategic white paper on becoming a generosity guide. And then you'll be able to receive lots of information on a monthly basis that builds upon your knowledge here. So I think we're ready to get started. And if you missed this moment, I'm going to put up the QR chat a couple more times in the presentation here and there, but it's also in the chat. Okay, so we've covered, Christine, thank you for covering a lot of this. When I hear my bio played back to me, it kind of makes me want to take a nap. It's exhausting. But the most important thing that I want to say here is that I am not a tax advisor. I'm a fundraising professional, just like everybody else on this call, and I'm a tax smart generosity guide. And my goal today is to help you become a generosity guide. Now, let me explain to you what that means. A generosity guide, and this is a term I've coined, so you're not going to find it in a dictionary, is a professional fundraiser like you and me who ignites generosity by helping donors navigate tax smart giving options and bridging the gap between donors and their financial advisors. Okay, I'm going to get into unpack what's in this definition, but essentially helping you develop the confidence and the knowledge to become the helper that gets donors to ask the right questions of their financial experts. We're very clear, we are not financial experts, we're not tax advisors, but we can guide donors to have the right conversations and ask smart questions that their advisors are then happy to answer for them as it pertains to their particular situation, and in some instances, help them implement. Okay, but you'll see this icon of a bridge. What I'm basically going to be asking you as a fundraiser to do is step in the on the middle of that bridge and connect the donors on one end and their financial and tax advisors on the other. And there's nobody better positioned to stand on this bridge than a nonprofit fundraising expert like you. So, why am I encouraging you to become a generosity guide? Well, you may have heard Professor Russell James at Texas Tech University over the past couple of years talk about his landmark research. He examined over 1 million tax returns from over a quarter of a million nonprofits over a 5-year period, and I highly recommend you Google him. I actually just spoke to him this morning, and he is really excited about this concept of a generosity guide. Why? Because his research shows that nonprofits whose donors give from wealth increase their fundraising revenue 5 to 6 times over. And he has quantifiably supported this conclusion. So we're all excited, right? Like all we need to do is get donors to give from wealth, and we're on the path to increasing our fundraising revenue 5 times over, right? But you and I both know that the devil is in the details. How do we get our donors to change their giving behavior? How do we get them to shift from giving from disposable income to giving from wealth? Because that's really tough. It's tough for a lot of reasons, honestly. The primary one being human behavior is really hard to change. Full stop. Forget all the tax mumbo jumbo. Human behavior is really hard to change. And the generosity guide strategy is going to help you motivate them to change their behavior and start giving from wealth. And when they start giving from wealth, it's better for them because it's more tax smart, and it's much better for you because they will start giving more generously over time once they start giving from wealth. So, what we're going to learn today is the Generosity Guide Playbook. Your goal is to learn how to arm donors with informed questions about how to give in a tax smart way and create the motivation for them to pick up the phone and reach out to their advisors. So, we're going to go through 4 key things plus a little bonus information at the end. We're going to talk about what the federal tax basics are and how charitable tax deductions actually work. We're familiar with your donation is tax deductible to the fullest extent of the law. We're getting into the fullest extent of the law part of that sentence. Second, I want to introduce to you, it's kind of a sidebar thing, key terms you need to know as a generosity guide, because this is terminology that will help you build your confidence. It will help you deepen your knowledge because you can read an article in the journal, the Miami Herald, whatever, on personal finance, and they're going to bring up these terms, and you'll be able to digest it a little bit better. And it also just helps you very conceptually with how to talk about all of these things. We're going to dive into what happened when the One Big Beautiful Bill Act passed and its impact both on individual and on corporate giving. The corporate giving is the bonus stuff I'm going to give you today. And then we're going to talk about conversation starters to convert your donors to wealth giving. So why now? Why are we at this very pivotal point? Well, the tax law has just changed and it's very confusing. And we can decide as fundraisers, this is not my role. I'm just moving forward. Your donation is tax deductible to the fullest extent of the law. It's on our website, it's on our donation transaction page. That's all I want to do about it. But when people get confused, they tend to back off rather than lean in. It creates uncertainty, and that stalls people out. Or they hear rumors and they don't get quality information, and they don't necessarily do what is the optimal thing to do. Or we can decide, hey, the tax law has just changed. We can take advantage of all of the uncertainty in the market and convert it into opportunity by becoming that generosity guide. And I'm telling you right now, donors really need your help in understanding this. So let's talk about first how federal taxes work, just in general. Okay. You have, depending on whether you file singly or as a married or joint couple, you have your income. You subtract deductions from it, and that gives you the taxable income against which your personal tax bracket is used. You multiply the tax bracket times your taxable income, and that's the federal taxes owed. Now, that's the whole concept. Okay. Now, for anybody who's actually prepared their own taxes or suffered through tax season, we all know it's a whole lot more complicated than this. But this at its essence is how it works. And once, um, I've got this word deductions written in red because you have two choices when it comes to taking deductions. And these two choices are choices you make each and every year, whichever is more beneficial to you each and every year. So you can take the standard deduction. This is a federally determined lump sum of money that says, hey, you don't need to collect all those annoying bits of paper doing your tax prep. We will just give you this lump sum to take as your deduction. And that's what you'll use. You subtract against your income to get how much you have to pay taxes against. Over the past couple of years, since 2017, the amount of money that you get in a standard deduction has dramatically increased. So lots more people are now taking the standard deduction. The deduction for a married or joint filing couple is over $32,000. Alternatively, you itemize your deductions. So this is where you get into the effort of all the tax acknowledgement receipts that you get from nonprofits or you issue as a nonprofit, mortgage interest, perhaps there are very high medical expenses and state and local taxes, and there also can be business expenses if you're a business owner. This list is actually pretty long, but I'm just giving you a couple of the ideas. And so what I want to point out here, which is a really big aha, is that charitable giving is only deductible for donors who are itemizing. Maybe you knew this, or maybe you didn't know it, and that's okay. But I want you to really think about um, the, we've got donors who are giving to your organizations because they care so much about your mission and you're doing a great job of building that relationship, and they feel like their funds are being put to great use for a mission that they really care about. The tax deduction is the cherry on top. People like that tax deduction. It's a little extra something that makes them feel good about doing good, and they're getting something a little bit extra. And they like that. But honestly, only people who are itemizing get this deduction. And what the correlation is that what you're going to find, I think it's in my next slide, there we go, is that most take the standard deduction, but most major donors will itemize. And we all know that it's our major donors that drive 80% of our revenue. So don't be fooled when you see statistics in articles about this topic that say what high percentage of folks do take the standard deduction, especially since it's so high now. Your core donors are most likely itemizing because they're more likely to be from a high tax state like Florida, or not like Florida, but a high tax state, or they are more likely to own their own business. They're more likely to own a home or a second home. Um, they are much more, and they're much more likely to be giving charitably. They much more easily can come up with receipts that exceed the standard deduction lump sum. So one of the good news takeaways from OBA is that um, it creates new opportunities for folks to itemize. So people who might have taken the standard deduction last year, this year they might be able to qualify to itemize. And I'm going to show you an example of this as we go into the sidebar. So and I've now explained to you how federal taxes work. I'm now going to take you through the key terms and acronyms every generosity guide should know, and then we're going to pull it all together in the next section. So what's the SALT deduction? SALT stands for state and local taxes. So back in 2017, the SALT deduction was capped under Trump's first administration at $10,000. That made a lot of taxpayers very upset. And so what happened with this new tax bill is that in 2026, that amount was raised up to $40,000 for folks whose household income is under $500,000. Okay, so this means that many more people will probably be itemizing going forward than they did before. And I'm going to show you why that is. Because remember, the standard deduction is 16 and 32,000 if filing joint. So if a donor pays $40,000 in state and local taxes and they qualify because they earn less than $500,000, $40,000 automatically puts them in the itemizing category. Okay, so that's why this one change in OBA is moving many more people into itemizing, which is how they get that extra icing on the cake when they give more charitably and get that tax deduction. Okay. Next term, I'm sure you've seen this one, donor advised funds or DAFs. So a DAF is a charitable giving account that anyone can easily open. I want to underline this, and actually, I have an article that's going to be out in Advancing Philanthropy magazine, the AFP magazine, in the fall that talks about how accessible it is to all intentional donors, this type of account. Has been an explosion in the marketplace for donor advised funds, and you can find a donor advised fund at every price point and every service level now, such that it makes sense for all intentional donors to have one for a variety of reasons. So when you see DAF, I don't want you to think this is for high net worth individuals. It is not. It is for anyone who spends any kind of significant time giving charitably on a regular basis. So what's special about a donor advised fund? It's a restricted fund. All the funds that you put in your DAF must go to nonprofits. You can't claw it back. That's why it's restricted. Donors, and this is the key, the secret sauce in all of this, the year that you put your money into the DAF, donors get their tax deduction. Okay, so let's say you decide you've come into some money or you got your bonus and you want to put a chunk of it into the donor advised fund. The year that you put the money in the donor advised fund, that's when you get your tax deduction, and that helps you qualify to itemize too, right? Because if the amount of the receipts exceeds that standard deduction amount, you're itemizing. Okay, so once the money's in a DAF, you can give to nonprofits at any time, and it's not a tax event anymore. And you probably know that when you, as a fundraising professional, receive a DAF donation, you're not even sending them a tax receipt. You're just giving them a donation acknowledgement letter because they don't need a tax receipt because it's not a tax event anymore. And then the other thing to know is that DAF funds are invested in the market and they are a form of wealth giving. Okay. The next category is IRAs, RMDs, and QCDs. This probably sounds less familiar than DAF does at this point. So an IRA, we're talking here in this context about a traditional IRA, not a Roth. In a traditional IRA, the money goes in pre-tax. Roth, it goes in after taxes. And the reason why traditional IRA is noteworthy is that the money goes in before taxes, but when the money comes out, you're taxed and it's a taxable event. We're going to talk about why that's important in just a moment. Connected to the traditional IRA is the RMD, the required minimum distribution that everyone with an IRA, traditional IRA, must take as mandated by the federal government beginning at age 73. Why does the federal government force you to take an RMD starting at 73? Because they want to start to tax you while you're alive. And even if you don't need the money that's sitting in your IRA, the federal government requires you to take this RMD and it's taxed as ordinary income. If um, you take money from your traditional IRA and give it charitably to a nonprofit, it's called a qualified charitable distribution, QCD. If you take money that's from your IRA and you give it to a nonprofit, it's a qualified charitable distribution. And even though the RMD, the required distribution, starts at age 73, if you're age 70 and a half, you can start making qualified charitable distributions. Okay? So, what's wonderful about this, and by the way, this has existed before OBA was passed, it's been this way for a while. A QCD, qualified charitable distribution from your IRA, see all these terms you now know, is tax deductible 100%, even if you don't itemize. This is the world's best way, if you qualify, to give charitably. In addition, if you're reducing the size of your traditional IRA, which reduces the size of your RMDs. If you hit 73 and you give a qualified charitable distribution, it counts towards your RMD and you can donate a lot of money this way, up to $111,000 per year if you qualify. And this number changes every year with, it's marked with to inflation. This year it's 111, or if you're a household couple, it's $222,000. Wow. Like talk about the potential for a transformative donation to your annual campaign. I'm not even talking about a planned gift. I'm not talking about a legacy gift, and I'm not even talking about a capital campaign gift. I'm talking about this is a pot of money that many of your donors have access to that they can be using to give to your organization. Okay? So now we've covered federal taxes, we've covered key terms and acronyms. Christina, I'm going to stop right here and just see if there's anything coming up in the chat that I should address right now, or if I should dive into my next section.
I don't see any questions, so I
Love
think
it.
everyone's ready to dig in.
Fantastic. I have worked so hard, everyone, to make this as clear as possible because it's not clear.
We actually did have a question just pop in,
Good.
and it's a great question. Can you do a QCD to your dad?
That's so funny. You guys are so smart. I get this question every time I give this talk. It's the first one that's asked. No, you cannot. You can't. You have to give it directly to the nonprofit. Okay. But here's a great example because we're going to get into how to be a generosity guide. As I told you, I'm not a tax expert. I happen to know the answer to that, but solidly. But if I were at all uncertain about a question like that my donor was giving to me, I'd say, that is such a great question. I'm not completely sure. That's a wonderful question you should ask your tax advisor. And I'm telling you, putting yourself out there as not a tax expert gives you credibility with your donor. because you're not pretending to know something you don't. And certainly, if you make something up and they find out it's different down the line, you actually kind of break the trust. So that's a great example of what I call the red line that each person should create for themselves and get used to saying, that's a great question. You should ask your tax advisor.
We also have one other question that popped in the chat. What is the RMD?
It depends on how much
Pardon,
money you've, hmm?
what is the amount
Right. It
of the
depends on
RMD?
it depends on how much money you've put into the IRA. It's different for every person.
Thank you.
Yep. Okay. So now let's talk about OBA. Here are the biggest changes to the tax deductibility of charitable gifts. So this is where it starts to get really confusing. And remember, confusion can mean opportunity if you're a generosity guide. So OBA broke charitable deductions in half, so to speak. If you're taking the standard deduction, they now have, those donors now have a tax advantage that they didn't have before. If you're itemizing, your tax benefit from charitable giving is now at risk. So let's start with the positive. Standard deductors do get a brand new tax benefit. Starting this year, so when they're preparing their taxes in the beginning of 2027 for this year right now, people who take the standard deduction can take something called above the line um, deduction. It's $1,000 if you're filing singly. It's up to $2,000 if you're filing jointly in cash gifts. And you do not itemize. You just hold on to the tax receipts and you submit them with your standard deduction, and you get this brand new deduction. And as I said before, people who take the standard deduction don't actually have not been getting a tax deduction when they give to your organization because they're taking the standard deduction. They're not submitting any of your receipts to the IRS. And I want you to know, you may, if you've been to Icon, there was a big presentation on this in San Diego in April, that it was actually AFP Global who lobbied for this law for years and years to get this done. Bravo to AFP Global and all of us AFP members. We helped to accomplish this. And I would say that because this is so uniquely new, the majority of folks who are taking the standard deduction are not aware that this is a new tax advantage. And you, as a generosity guide, can be telling them. You also can include it on your website and in your newsletter. That's a great way to be communicating this to to the vast majority of people who are your donors. Okay, so here's bad news. Tax itemizers, think major donors, are now hitting a huge tax disadvantage. So the deduction that you can take if you itemize starts only after your giving exceeds 0.5% of your adjusted gross income. That's AGI. You're like, that's such a word salad. What on earth does that mean? And guess what? That's why it's complicated, because it's complicated. So let me spell this out for you. If a donor's household has $400,000 in adjusted gross income collectively, so that top line when we were talking about how federal taxes work, the top line is 400,000 before deductions start. The first $2,000, which is 0.5% of $400,000, the first $2,000 they give every year isn't tax deductible. So I want to say this again because there's math involved here. And for every household, the number is going to be different. If a household has $300,000 in AGI, the first X percentage, 0.5%, they give off of 300 isn't going to be tax deductible each and every year. So this creates a wall basically that people have to climb in their charitable giving before they then get the benefit that they've been used to getting all along for years and years. So the federal government has taken away a huge tax benefit for itemizers. And if this puts you in a rage, it should. In fact, AFP Global was able to do a calculation that said that even though there are all these standard deductors who now have a new tax advantage, the revenue associated with this tax disadvantage so offsets the benefit of the tax advantage that standard deductors are going to get that fundraising revenue is going to be in the negative. I hope that was clear. But at any rate, it's not great. Okay. It's lemons. And I know that our community has been handed a lot of lemons this year, but this is what I love about this concept because if you become a generosity guide, you can turn lemons into lemonade. Okay. So what OBA has done is they've pinched the tax deductibility of major gifts. You've got donor confusion, you've got pullback, status quo, and above all, people hate losing a benefit they once had. It's called loss aversion, and they will take action to protect it, to hold onto it. So here's how we can pull together a lot of the things that are happening to get people to start giving from wealth and turn the lemons into lemonade. If you're able to guide your donors towards tax smart giving strategies, it will help restore their tax benefit and it will start them, it will change their behavior. They will start giving from wealth, which is what you want them to do as a nonprofit. Because by giving from wealth, it unleashes generosity, which is a whole other conversation. But so let's talk about, as a generosity guide, a couple of the strategies for you to be familiar with as you're approaching a major donor on this topic of uh, giving. And putting this chart in front of them is not what I'm recommending that you do. I just want to show you the math here. And I'm also going to say you don't even need to master this math. Just try to absorb it conceptually. Okay. So we're going to go back to that $400,000 adjusted gross income AGI household in which they are giving $2,500 a year from their credit card to their favorite nonprofits. The first row shows that when they give $2,500, the first 2,000, the first 5%, 0.5%, they don't get to take that deduction. So they're only able to get a $500 deductible from their $2,500 gift. In year two, it happens again. In year three, it happens again. And in year four, it happens again. And grand total over 4 years, their total tax deduction is only $2,000 off of giving equaling $10,000. However, if that same household opens a DAF and funds that DAF for all the giving that they're anticipate giving over 4 years. So instead of giving out $2,500 each year, they take a lump sum, $10,000, and they put it into the DAF. You and I both know, because we talked about this, they're going to get their tax deduction right then. This helps them itemize. And here is the big news of what happens under OBA. They put the $10,000 into the DAF. I'm now on the bottom row of my chart, year one. They put the $10,000 into the DAF. They are still subject to the 0.5% ding. So they lose the $2,000 in a tax deduction and they get to take an $8,000 tax deduction. Year two, three, and four, they're distributing the money, but it's not a tax event. So they don't get dinged by the 0.5%, right? So at the end of the day, $8,000 is what was deductible off of a $10,000 charitable giving uh, effort. So the first, they're both doing the same thing. They're both giving away $2,500 every year. But in the first instance, your major donors are only getting $2,000 off of a $10,000 donation as a tax deductible. The bunchers are getting $8,000 of that 10,000. So the DAF strategy, the bunching strategy generates $6,000 more in deductions over 4 years for the same $10,000 donation. Okay. So the cost of inaction, of not changing your behavior, is really high. This is not you're saving 50 bucks. This is enough of a reason for a donor to want to call their financial advisor and say, hey, I think I should be giving differently. Can we talk about DAF bunching? Okay. Additionally, um, as I've mentioned to you before, it helps them qualify for itemization, but Um, I don't know if anybody on this call has their own donor advised fund, but it is a fantastic way to track your giving history. You can see exactly who you've given to, when you've given to them, and how much you've given to them. So by putting this tool in donors' hands, you're actually helping donors give more consistently in all kinds of ways. And that helps you enormously. It's also much less tax time paperwork, because the only thing that you need to submit to the IRS is evidence that you put the money into the DAF in that 1 year. You do not need to collect all of the receipts from all the nonprofits that you give anymore. And I want to emphasize again, there's a DAF for every intentional donor. There's a huge marketplace of DAFs at every price and service level. We've done the research on it, and I encourage you all to actually open a DAF and do the research and find one that works best for you. It will help you be a lot more confident, honestly, in recommending this strategy. And I think it's such a great giving experience. So, strategy number two is QCD giving. So if you have an aging donor roll, you've hit the jackpot here. Because as I mentioned to you before, QCD giving is the most tax efficient way to give, full stop. I've mentioned to you before that you can make a QCD at age 70 and a half, up to $222,000 per couple. Plus, once you're 73, you're required to take a required minimum distribution, an RMD, which would be taxed as ordinary income unless it's gifted to the charity at a QCD. What would your donors rather do? Take that money, pay it in taxes, or give it to you charitably? Hmm. Of course, the money in an IRA is used for retirement. There are many people who have an IRA because they're not working anymore, let's say, and that's what they are living off of. But there are lots of donors, particularly major donors, who have other sources of income, real estate, business, the stock market, other brokerage accounts. They may still be working. Both my parents are still working. Um, so they don't need this money per se. And this is where there's a huge opportunity. It's 100% tax deductible. There's no 0.5% ding. It doesn't matter whether these folks are itemizing or taking the standard deduction. And every single one of them, even if they were never a major donor in the past, they actually now have the potential to make a major gift to your annual campaign every year. There are other tax smart giving strategies, by the way. I want to talk about those two in particular because they're, I think, the strongest ones that you can lead with as a generosity guide. So let's talk about how you can step into this new role. Again, the big picture here is that um, you're trying to get them to give from wealth giving strategies, giving from your IRA, giving from a DAF helps to itemize, it helps them qualify to itemize, and helps major donors offset the loss of tax benefits. And I'm telling you, and Christine and I were having this conversation before the webinar started. You can be initiating these conversations with donors Their financial advisors and tax advisors are by and large not. You're thinking, I'm not the expert here, that's their job. Their job is actually also filled with a million things that they need to accomplish with their clients. How their clients can be giving more tax efficiently to their favorite nonprofits is not on their top 10 list. So the conversation isn't happening. So, what I'm suggesting here is that fundraising professionals be the ones to guide the donor to ask, to pick up the phone, to send the email, to ask good strategic questions of their tax advisors and financial professionals. And you've got, many of these donors are going to start losing a tax benefit that they've really gotten used to. So you've got loss aversion effect on your side. And if you point that out to them, donors will take action. They will change their behavior. And the hardest part of the whole math of this whole dynamic in converting donors to wealth, being true to what Professor James's research showed us, is getting them to change their behavior. And if financial advisors and tax advisors, it's not on their top 10 list, we can choose to step into this role as a generosity guide and enormously benefit from donors who are starting to give from wealth. Or we can choose to not do anything about it, but think about that 0.5% ding that so many of your credit card donors are now going to be facing. They may pull back within their giving, doing nothing. So here's a fun Venn diagram. The OBA tax rules. I don't know if they were designed this way, but the OBA tax rules are designed to help push folks from giving from disposable income to giving from wealth. That's the tax smart giving part of OBA. But they have to be willing to change how they give, or they're going to lose the tax benefits. So, this is another thing that I love about being a generosity guide. How many of us have a hard time getting folks to talk to us in person, in email, by phone? If you want somebody to answer your voicemail, leave them a message like, "Hey, I've got a tax smart giving tip that you can act on right now. Let's talk. Give me a call." Tax saving tips are irresistible. You will get the call back using this technique to get into the conversation. So, what does the conversation sound like? So, if you know, or you're guessing that you're talking to an older donor who might qualify, we never really know, right? Who might qualify as someone who's 70 and a half. Here are some thought starters. There are a lot of changes to the tax code this year, so we're contacting our most loyal donors, you, to provide some tax smart guidance. This is very important. I am not a tax expert, but we're starting to see other donors given this way. And then you can say, so people are going to be like, okay, so tell me more. How are people giving? It's so safe to start with this line. You're probably not old enough to qualify for a QCD. Oh, you are? Oh, your spouse is? Oh, you're not yet old enough to qualify for a QCD, but you are going to be soon and you want to learn more. You want me to keep talking? Okay, well, here's what's going on. Okay, so you never assume that they qualify. That's why I love the you're probably not old enough to qualify because you're going to get people who are like, "Oh, sweetie, you're adorable." Or you're going to get someone who says, "You're right, I'm not, but I'm getting close." Or "You're right, I'm not, but my spouse is. Tell me more." For itemizers who don't qualify, if they say, "Nope, I don't," then you just shift gears. Or if you know that they're categorically not going to qualify, you just lead with the DAF strategy. With so many tax code changes this year, we're contacting our most loyal donors to provide some tax smart guidance. I like using the word guidance, not advice, because that sounds like tax advisory. I like the word guidance. I'm not a tax expert. We're starting to see other donors given this way so they don't lose their tax benefit, underline the loss aversion thing. You can also say, I just opened up my own DAF online. I can't believe how easy it is to use. I recommend shopping for a DAF online or asking your advisor. And please reach out to your financial advisor and ask them to explain the bunching strategy, because that's how you're going to get that tax benefit. For folks who are taking the standard deduction only, here's another hot tip. If you have donors from the 2024 year that didn't give you funding in 2025, you can ring them up or email them and say, you are the smartest donors in the world for not giving last year, even though we missed you. Did you know that you may be eligible for a brand new tax deduction by making your gift this year instead of last year? We're hearing this is a new tax benefit for people who take the standard deduction. Check with your tax advisor. Oh, you don't take the standard deduction? Well, then you should definitely be looking into opening up a DAF and bunching. See how natural this is? You're just coaching, guiding. We're not using any buzzwords, actually. And the goal here is to create the motivation, pique their interest in doing something, and then getting them to ask the right questions to their advisors. So I know I'm short on time. We've covered a lot of these things. What I'm really asking you to do is really shift your role as a fundraising professional to incorporate this idea. So I mentioned to you before, this is a pretty dense, meaty conversation. We've developed a written guide, a training guide for you, and a white paper that talks about the generosity guide idea. I highly recommend that you join our mailing list to get it. And if you snap that QR code, you can get it, or I put the link in the chat. I just want to say, I'm going to go through this extremely quickly because we're on Miami time and we started 10 minutes late. So, OBA impacts corporate giving too. And this will be in the training guide, so I'm going to go through it super fast right now. Starting this year, the first 1% of adjusted taxable income, which is how corporations talk about revenue, is not tax deductible. This is huge. This means that if you're a sales force and your adjusted taxable income is $500 million in an annual year, the first $5 million of your charitable giving is not tax deductible. So the first $5 million of their employee matching, of their corporate sponsorship, the first 5 million of it is not tax deductible. It is after that. But that's a problem, right? So, one of the ways in which this is still in flux because corporations are figuring out different ways to work through this. Some of them have foundations, some of them are going to open foundations, or they might be shifting how they recognize their sponsorship into a marketing expense instead of as a donation. And you should be asking your sponsor if that's what they plan to do. This makes it a lot more important for you to demonstrate and document the marketing value of your sponsorship, or creating multi-year sponsorships that they pay for upfront so that they can sort of do bunching that way. And you're going to have to keep a close eye on the employee matching gift policy. This is a very, very popular benefit that employees get, but it is impacted by OBA. And I haven't yet seen how corporations are handling it. But, don't be fooled. Corporations are not purely altruistic animals, they're profit oriented. So, this tax situation is going to have an impact on your thinking. So, here's the QR code again in case you missed it. Wrapping up, you should be standing on the bridge. Christina, I'd love for you to share the little exchange that you had at a networking event recently,
Yeah, so
because Christine stepped on the bridge.
I sure did. I was at an event with a lot of different advisors, so for like CPAs, estate attorneys, a lot of people with a lot of initials behind their name. So, and I was talking to someone and I just said, oh, it was a CPA. And I said, oh, have you heard about bunching? And they looked at me and they're like, bunching, that's not a thing. And I don't think they meant it in any negative way. I was like, oh, well, you should you should look into that. And
Yeah.
and then at that same event, I said, do you know what a DAF is? And I was surprised at how many people said, what's a DAF?
Hmm.
So it just taught and reinforced with me that never assume just because the initials after their name that they know, because there's a lot of information, a lot of movement. So it really just kind of reinforced everything that you're talking about to make sure that we are that generosity guide.
And if you look up One Big Beautiful Bill Act on Wikipedia, you'll see that the impact on charitable giving is like one sentence at the end of three very long paragraphs that detail all the changes in OBA. We are a tiny freckle of this law, which so it doesn't surprise me that this is just not top of mind for tax experts and financial advisors yet. Um, that's why you helping your donors show up with the right questions is so vitally important. You don't need to be a tax advisor. You're a generosity guide. You don't give tax advice, but you're putting your donor in a better place by helping them give in a better way. And donors really appreciate this. So, you're doing relationship building when you're having these conversations. And guess what? When they open up a DAF that you recommended, no one else did. You recommend that they do this. They open up the DAF. Guess who they're going to be loyally giving to forevermore? Your organization. And it unleashes this generosity as Dr. James's research shows us. So it's a win for your donors and it's a win for your mission. So thank you very much for attending How to Become a Generosity Guide. Thank you so much, Christine, and your chapter for sponsoring me today. I'd love to stay connected with you all. Please connect with me on LinkedIn. You can reach out to me directly at info@donorboom.com. And I'm going to stop sharing, and I'd love to see you all and see all of your questions about this topic.
So I don't see any questions in the chat, but if anyone has any questions, drop them in the chat, or just start talking. But again, thank you. This is we're so grateful for your support and for presenting on this important topic. For everyone, we will be emailing the recording and sharing the information as well. And so it will be readily available if to everybody that registered. And we're so grateful. We'll hold for a moment or so. Adler says, thank you for the wonderful information. And I could not agree more. I don't think we can hear this enough so it gets in our bones. And I loved how easily you made it conversational. Very, very
And for
conversational.
those of you who are now interested in opening up your own DAF, um, there are almost 1,000 providers out there, by the way, who now do it at very different service levels. The most inexpensive ones you are going to find at like Daffy or GoFundMe just started one with very, very tiny requirements to get started. Um, you can start there. You can go to wherever your brokerage account is if you have one. They typically offer a DAF, and you can bundle it in with the costs of whatever you're paying for your brokerage services. Community foundations offer them. They tend to be the most service rich and have the highest requirements. So there's this very wide range out there. Um, but yeah, that's one of my top piece of advice is that you open one yourself.
Thank you so much. I don't see any questions. I haven't heard anyone. So that means you
Wow.
just created a bunch of generosity guides, and we are just so grateful to you. Round of virtual applause.
Thank
But
you.
again, thank you for this information, and we'll definitely send it out to our chapter and all of our attendees. And just thank you for sharing your knowledge and expertise.
Thank you all. I love being in the fundraising profession. It's such an honor to have you as a member of my community.
Thank you so much. Have a great rest of your day, everyone. Thank you for tuning in, and stay tuned for some upcoming educational content coming down the pike. And again, thank you so much.